Everyone, welcome to episode number 4 of Assets Under Management. We got through kind of the value setting and mindset in the first couple episodes. Today's really exciting. This is where we actually talk about what we think is the most important element in terms of starting in the real estate game, and that is being able to analyze the operating team that you're working with. Gabe, do you want to talk us through how we go about finding the right people to work with and invest our money with?
Yes, yes. And before we dive into exactly what you need to do, let's talk about why. So, look, through this season, we're going to have a couple episodes, back to back here that are related to analyzing opportunities. And there's a lot of debate about this in the investment community. When you're partnering on an investment like these private equity investments in multifamily, some folks love to analyze the deal and use that as their primary sort of decision maker. And I think there's going to be some opportunities for us to teach you how to do that, as well as how to pick a really good market. But we are starting off intentionally with how to pick a great sponsor because we believe in the concept of picking the jockey before you pick the horse. In this particular sport of investing, ethics, integrity, work ethic, ability to deliver results, experience, all those things are more important, in my opinion, and in Misha's opinion, than in the actual deal itself. Because you could take a perfectly good market with a perfectly good opportunity and blow it. And we've seen that happen a lot over the last 6 to 7 years, where people really weren't the right operators, either for a specific business plan or for this business in general. So we want to be able to help you work through that. And I'll sort of drive through this first piece, Misha. I want to talk about how, right? How you can approach this this particular endeavor, which is for you to figure out who's good. Now, the beauty of social media and podcasts like this is you do get to learn a lot about operators based on the content that they have available out there in the world, out there in the ecosystem. And if you're lucky enough to have done this in the way that many people do, which is through like a handshake introduction at an event or something like that, well, then that's great. You get to know people on the surface level. What I always recommend doing is gathering up a bunch of questions and really thinking through which of those questions you have answers to before jumping on the phone with a potential sponsor or sponsorship group. And then either directly or maybe sometimes indirectly by asking for referrals to other investors, you can learn a little bit more about the investor by going through a series of questions. Now, remember this. These investors are very busy people, and they're putting a lot of money at risk, and they're putting a lot of time into raising capital for these larger deals. I would highly recommend using their time, but using it wisely. So I think that's the first thing of note is I've seen people kind of not have the courtesy of limiting the number of questions that they're asking the sponsor. And I would just say, hey, look, if you want, down in the details here, me and Misha have created a set of questions for you to vet a multifamily deal sponsor. And you want to grill them. You want to have a good opportunity to kind of ask them tough questions, but they are really busy. So you need to respect their time in the one-on-one conversations and ask only 10 to 15 of these questions. Pick the ones that you want the most. And that'll help you do one really important thing. It'll let you make sure that you're not getting a good salesman to lock your money up for 5 years and then under deliver. So you've really got to make sure you ask these questions on the front end. So let's start with one big question. Right? Then I'll cover off on 5 questions, and then I'm going to pick Misha's brains to see if he's got any additional. But I think the number one question I always like to lead off with is, how many years has the sponsorship group been involved in multifamily real estate? Now, I've seen people's level of effort in this business ebb and flow. So sometimes it doesn't necessarily mean that a 15-year veteran in the business is better than somebody that's brand new. But it is true that this is an experience-based business. It's like a skill. So if you're going to pick a teammate for your professional soccer team, you're going to want a soccer player that's played a lot of soccer. You're not necessarily going to want some under 17 kid who just came up, because even if they're ridiculously athletic, they don't have the mental experience in a skill sport. And in this business, if you don't have the experience in a skilled business, you're going to fail most of the time. It's very risky to take on investing with people that are brand new. Now, it can be done, but typically those brand new people that are rock stars have partnered with more experienced people like Misha and I and Nelson and Sean, our friends on our investment group. So first question, it's always really easy one, is how long have you been doing this? Okay. Another thing you want to do is look at the actual track record for anybody that has one. So in particular deals, you want to make sure that they have a track record in deals similar to the one being presented. If somebody's done a dozen deals, but they've never done a deal in Nashville, Tennessee, and they're presenting a deal in Nashville, Tennessee, it doesn't mean they're going to fail, but it definitely means there's more risks that they are not aware of. If somebody's done a dozen deals, but they're doing one new deal for a 2023 build that is 2% occupied, and all the rest of their deals were 1972, fully occupied, stabilized deals in a different part of town, I think there's still risk there. Every different investment opportunity is unique. It's a unique butterfly. And just because two deals were in a similar neighborhood, the similar vintage, doesn't necessarily mean that they're going to have the same trajectory for an investment. But experience in one particular area in similar deals, in similar submarkets, or in the same submarket is critical. So ask about what asset class and vintage they've worked on before, and if it matches what they're presenting, it's probably a good chance they know what they're doing, right? Similar year of construction, similar median income in the area. If they've ever worked as a sponsorship group is a really critical question too, right? A lot of these sponsorship groups are newly formed. Maybe the main decision makers haven't ever worked together, and that's a risk because you could have a bunch of personalities that bump heads in year 2 or 3 when things get a little tough, and that's never fun. So you want to make sure you get a better idea of the track record and whether they've worked together as a group. Also, a really important one that's going to uncover some nuggets that you may have not heard, or uncover the fact that you're not working with a person that really understands the deal. Maybe there's a fund manager that's pretending to be more of a lead sponsor than they are. But you should ask, what do the sponsors love about the deal? And that should light their fire. They should be able to go until you have to cut them off on that particular question. And they should definitely hit their top 3, if not more, points on exactly why they love the deal. And it shouldn't be a big at the beginning of that question. They should be able to fire off straight from the hip because they've spent hours and hours and hours prepping if they're doing this business right. And then the fifth one that I'll mention is I think that you should be asking for their overall philosophy and investment strategy in real estate. What exactly is it that their approach is to this business plan? What are they trying to accomplish on the specific deal? Now, there's a number of other questions you could go into. And again, we will attach them in the notes there if you guys want to download. I'm going to stop there and see, Misha, what are some of the things you think people should be asking about when they're trying to pick a lead sponsorship group that they want to invest with?
Yeah, I think I would want to know, how the team is developed. So is it top heavy? Does everyone have, different skill sets that they bring to the table? A question that I always get a lot is like, if you got hit by a bus, then what happens next, right? So, and I think that's a good question to ask, maybe not exactly that way, but just making sure that if something were to happen to one person, is this team still going to be able to function at a high level? So that's definitely one question that I would want to know. Other thing, I mean, for us specifically, I think, what are people's proximity to the actual property? If there's a fire, if there's XYZ, like who's going to be there on site to be able to help out? I think we're uniquely structured to be able to handle situations like that. But, if everyone's in Texas and your property's in Arizona, you may not have that same type of visibility. And then obviously from our perspective, who else do they work with? What property management company do they use? How do they, what banks are they using? Have they used those companies before? What's those relationships look like? Are they willing to provide recommendations? How many people are going to be willing to vouch for them for investors that have been used in the past that can kind of talk through the process? And are they willing to meet in person? So those are some of the things that I would look into if I was vetting an operator.
2 more quick ones. I like to ask about how the groups handle communications and reporting to their investors throughout the life cycle. I've never experienced a deal that I wouldn't reinvest with the sponsors on that um, that had good communications. And to say that differently, as long as you have good communications, if you can go above and beyond, tell everybody what's going on in the good times and in bad, give great details, you just create this level of trust. And that's all I want from a sponsorship group. Again, I want great returns, I want results, but if I trust that you're doing everything possible on that deal, I'm not going to give you a hard time if it doesn't work out perfectly. However, I'm
Yeah.
giving you my money and you're telling me everything's going great until I turn around and realize that you've been not straightforward. That's a really big red flag. And I'm not just going to not invest with you. I'm going to tell everybody I know not to invest. That's
Yeah.
unfortunately the problem with taking my money as a limited partner is that I do have a big mouth and a big network. And so, I think that there's way more opportunity out there for people that have great communication and reporting for their investors. I also like to ask the
Yeah.
sponsors for the deal, how is the sponsorship group's alignment of interest with investors on the deal? Now that can come in a lot of different forms. Some people will ask just, how much money are you putting in the deal? And that's not the only
Hmm.
way to sort of prove out that they have alignment of interest. It can look like a better alignment of interest when you have certain structures like waterfalls or performance metrics and hurdles. So I really like to make sure that they're not just making out like a bandit on the front end. One thing I've seen a little bit of in the last 5 to 6 years that you should be wary of is those deals where they have vertical integration and it's not certain that they have to perform in order to make a good chunk of money. Like an example would be a team that gets paid for construction, gets paid for asset management fee, gets paid for acquisition fee, right? But then maybe doesn't really have any results to drive the overall performance of the asset. And so I think, you want to make sure there's a pref on some deals that are structured that way with that kind of a team, or you want to make sure that there's some performance hurdles where the team has some responsibility and skin in the game, or just find a sponsorship group that puts a ton of money into the deal themselves, and you'll know that their interests are aligned. For example, like on me and Misha's last deal, we raised the $10 million, but 2.2 million of it came from Misha, myself, and other teammates at the core portion of the GP. So it was an opportunity to kind of demonstrate that, like, look, over 20% of the limited partnership is our money. We're not going to tank this deal. And I think that's an important part of making sure there's some alignment. So, with that, unless you have anything else you want to add, I think we can sort of wrap up the episode. But we definitely wanted to remind you guys to stay focused on vetting the deal sponsor, or at least put as much effort on that as you do on vetting the market and the actual sponsor themselves. In the next 2 episodes, we'll cover those areas: vetting a market and vetting the deal itself.
Yeah. No, I think this is short and concise and exactly what people need to know. So I'm happy with us signing off on this note. And yeah, like Gabe said, make sure that you follow those steps before you invest. All right. Thank you guys.